Hi, welcome back to Cheryl Trades LEAPS. The biggest mistake I see investors making in 2026 is asking the wrong question. They ask, what stock should I buy? But before I look at an individual stock, I want to know something much more important. Where is the money going? Because you can buy an amazing company at the wrong time and watch it do absolutely nothing for months. Or worse, you can buy LEAPS on that company and lose money even while the long-term business remains perfectly healthy. That's why one of the most important ideas in my LEAPS strategy is sector rotation. I don't just look for great companies. I look for great companies inside sectors that are beginning to attract capital. Then I use LEAPS to participate in that trend without tying up the same amount of capital I would need to own 100 shares. But there is a big difference between using LEAPS intelligently and simply using leverage to gamble. Today, I'm going to show you how I combine sector rotation, fundamentals, technical analysis, implied volatility, and LEAPS into one system. And most importantly, how I try to do it without blowing up my portfolio when the market turns against me. Let's get into it. Part 1. Why sector rotation matters. Every market has leaders. But those leaders change. Technology may dominate one phase of the market. Then industrials begin outperforming. Energy starts attracting money. Utilities strengthen. Financials suddenly wake up. And eventually capital may rotate back into growth again. This is sector rotation. Institutional investors are constantly deciding where they believe the best risk-adjusted opportunities are. And when billions of dollars begin moving into a sector, that movement can last much longer than most retail investors expect. That's why my process doesn't begin with, what stock looks cheap? It begins with, what sector is entering the right stage of its cycle? My framework looks like this: market, then sector, then industry, then company, then entry. And only after all of that do I ask, which LEAPS contract should I buy? The option is the last decision, not the first. That's extremely important, because a LEAPS contract cannot rescue a bad investment thesis. Leverage only magnifies whatever decision you already made, good or bad. Part 2. Follow the capital, not the headlines. One thing I'm watching closely in 2026 is how interconnected some of these investment themes have become. Take artificial intelligence. Most people hear AI and immediately think about semiconductor stocks. But think about what actually has to happen for AI infrastructure to expand. Companies need chips. Those chips go into servers. Servers go into data centers. Data centers require enormous amounts of electricity. That electricity requires generation capacity, transmission, grid upgrades, natural gas, nuclear power, cooling systems, electrical equipment, construction, networking. So instead of chasing the stock that already went up 150%, I want to ask, where does the money have to go next? That question is much more interesting to me. Maybe the opportunity isn't the semiconductor company everyone is already talking about. Maybe it's the company building electrical infrastructure. Maybe it's a data center operator. Maybe it's power generation. Maybe it's natural gas infrastructure. Maybe it's networking. Maybe it's industrial automation. The goal isn't to predict the next headline. The goal is to understand the capital cycle. Part 3. I don't buy a sector just because it's going up. This is where sector rotation can become dangerous. Investors see energy outperforming for 3 weeks and suddenly decide, I'm an energy investor now. That's not what I'm talking about. By the time everybody agrees that a sector is hot, the easy money may already have been made. I'm looking for something closer to late accumulation transitioning into early markup. Think about a sector moving through 3 broad stages: accumulation, markup, distribution. I want to find sectors where institutional demand appears to be strengthening before the trade becomes obvious to everyone. Some of the things I watch include relative strength against the S&P 500. Is the sector beginning to outperform SPY? I watch the 20-day, 50-day, and 200-day moving averages. I look for improving market structure, higher lows, higher highs, breakouts that actually hold, increasing volume on strong days, improving earnings expectations, industry breadth, valuation. And most importantly, what catalyst could keep this trend alive for the next 6 to 18 months? Because I'm not buying LEAPS for a 3-day move. I want a thesis that has time to develop. Part 4. Great sector doesn't automatically mean great stock. Let's say I become bullish on energy infrastructure. That doesn't mean I buy the first energy company I see. That doesn't mean I buy the first energy company I see. Now I move down another level. I ask, which companies have the strongest fundamentals? Which companies are actually growing earnings? Which companies have manageable debt? Which have pricing power? Which companies are benefiting directly from the trend? Which businesses have durable competitive advantages? And which stocks haven't already priced in 5 years of perfect growth? Because a great business can still be a terrible investment at the wrong price. That becomes even more important with LEAPS. When I buy shares, time isn't working against me. With options, eventually it is. So I want multiple things working together: strong sector, strong company, reasonable valuation, strong long-term trend, good entry, and then good option structure. I don't need all 5 to be perfect, but the more of them that line up, the higher my conviction. Part 5. How I use LEAPS. This is where my strategy is very different from buying short-term calls. I'm not looking for lottery tickets. I'm not trying to predict where a stock will be Friday afternoon. I'm using LEAPS as a capital-efficient way to gain long-term exposure to businesses I would otherwise be comfortable owning. That's why I generally prefer higher delta LEAPS, usually somewhere around 0.70 to 0.85 delta. Why? Because higher delta LEAPS tend to behave more like the underlying stock. Suppose a stock trades at $200. Owning 100 shares would require $20,000. Instead, maybe I can buy a deep-in-the-money LEAPS call using substantially less capital. I still gain meaningful exposure to the stock's movement, but I don't have to deploy the full $20,000. That remaining capital can stay in cash. It can be deployed into another opportunity, or it can simply reduce my overall portfolio exposure. That's what I mean by structural leverage. But I want to make something very clear. Having access to leverage doesn't mean I should use maximum leverage. If I have $20,000 and a LEAPS contract costs $7,000, I don't buy nearly 3 contracts just because mathematically I can. That defeats the entire purpose. The advantage of LEAPS isn't how much leverage can I get. The advantage is how much capital can I avoid putting at risk while maintaining meaningful exposure? That's a completely different mindset. Part 6. The Delta 1 mindset. I think of my higher delta LEAPS almost like synthetic ownership, not literally the same as owning shares. There are important differences, but psychologically, I'm not sitting there watching every 5-minute candle. I'm thinking, would I want to own this company for the next 2 or 3 years? Is the investment thesis strengthening or weakening? Is the sector still working? Are earnings moving in the right direction? Has anything fundamentally changed? That's what I call the Delta 1 mindset. I'm using an option, but I'm thinking like an owner. That reduces one of the biggest problems LEAPS investors have. They buy long-term options and then manage them like weekly calls. The stock drops 4%. They panic. The option drops 12%. They panic even more. And suddenly, an investment that was supposed to have an 18-month thesis gets sold because of 3 bad trading days. That's not how I want to manage LEAPS. Part 7. IVE matters more than most people realize. Finding the right company isn't enough. You can be right about the company, right about the direction, and still dramatically reduce your return by buying the option when implied volatility is extremely expensive. That's why I pay attention to IV. But I'm not simply asking, is volatility low? I'm asking, is this option's volatility attractive compared with its own normal range? Because every stock is different. A 35% implied volatility might be expensive for one company and cheap for another. I particularly like looking for opportunities after uncertainty has been removed. Earnings can be one example. Before earnings, options often contain additional event premium. After earnings, implied volatility can fall sharply. If the company reports strong results, the thesis remains intact. The stock doesn't become ridiculously overextended, and option premiums normalize. That can create a much more attractive LEAPS setup than chasing the stock immediately before the announcement. That's why I prefer trading the reaction rather than gambling on the event. Part 8. The order matters. This is probably one of the biggest lessons in this entire strategy. My process is not find cheap option, buy option, hope. It's market environment, sector rotation, industry strength, business fundamentals, valuation, technical entry, implied volatility, LEAPS contract, position size. When people start with the option chain, they often find themselves inventing reasons to justify a trade they already want to make. I want the investment thesis to exist before I ever look at the option. Part 9. A simple rotation score. One way to make this more systematic is to create a sector score. For example, I could rate a sector from 0 to 10. Trend strength, 2 points. Relative strength, 2 points. Earnings growth, 2 points. Valuation, 2 points. Institutional participation, 1 point. Macro tailwind, 1 point. That gives me 10 possible points. Maybe I decide I don't even look seriously for LEAPS unless the sector scores 7 or higher. The exact scoring system isn't the important part. What matters is forcing myself to answer, why do I believe this sector deserves my capital, instead of saying, everybody online is talking about it. That's not a thesis. Part 10. Rotate the thesis before you rotate the entire portfolio. Here's another important principle. Sector rotation doesn't mean I'm constantly selling everything I own. Suppose I own several technology companies with strong fundamentals. Then energy infrastructure starts showing relative strength. I don't necessarily dump my technology positions and chase energy. Instead, I might stop adding new capital to the overextended sector, let my strongest positions continue working, trim positions where valuation has become extreme, and direct new capital toward the emerging opportunity. In other words, rotate the thesis before you rotate the entire portfolio. This helps prevent one of the biggest mistakes in investing, selling yesterday's winner to buy today's winner, right before today's winner becomes tomorrow's loser. Sector rotation should improve capital allocation. It shouldn't turn your portfolio into a revolving door. Part 11. How I think about position size. Not every opportunity deserves the same amount of money. I might love the company, but perhaps the sector trend is still developing. That's a smaller position. Maybe the sector is strong. Fundamentals are improving. Valuation is attractive. Technicals confirm the move, and IV is reasonable. Now conviction is higher. I can scale accordingly. But I never want one LEAPS position capable of destroying my portfolio. This is especially important because options move faster than shares. A stock falling 15% can easily translate into a much larger decline in the LEAPS contract. So I size the position based on what I could tolerate losing, not based on how much money I hope to make. Part 12. The LEAPS compounding flywheel. Now we get to the fun part. Suppose the strategy works. I identify a sector early. I buy a quality company. I structure a good LEAPS position, and over the next year, the stock appreciates significantly. Eventually, I take profits. What happens next? I don't automatically buy the same sector again. I start the process over. Where is capital moving now? Which sector is undervalued now? Which earnings cycle is accelerating now? Where is institutional accumulation developing now? Then I redeploy some of those profits into the next opportunity. The cycle becomes find rotation, build position, let the thesis develop, take profits, recycle capital, find the next rotation. That's the compounding flywheel. But there is one rule that matters enormously. I don't recycle every dollar. Suppose I deploy $20,000 across LEAPS strategies and eventually grow that capital to $30,000. Portfolio. I don't necessarily take all $30,000 and put it back into options. Maybe I redeploy $22,000 and I pull $8,000 out of the risk engine. Cash, shares, treasuries, whatever fits the broader. That way, successful LEAPS trades gradually create permanent capital, because compounding isn't just about making the portfolio larger, it's also about protecting what you've already earned. Part 13. How I handle losses. This is where I disagree with one piece of conventional trading advice. People say, cut losses quickly. That's excellent advice for some trading strategies. But with LEAPS, I think we need more nuance. I don't automatically sell because my option is down 20%. A LEAPS contract can move dramatically even when the long-term investment thesis hasn't changed. Instead, I ask, why is the position down? Did the market correct? Did the entire sector pull back? Did implied volatility fall? Did the company miss earnings badly? Did management reduce guidance? Did competition change? Did my original catalyst disappear? Those are very different situations. My exit isn't based purely on my option's percentage loss. It's based primarily on thesis invalidation. If the business changes, I leave. If the sector structurally breaks down, I reevaluate. If earnings expectations deteriorate dramatically, I reevaluate. If the reason I bought the company no longer exists, I leave. But if the stock drops 12% because the entire market is correcting while my long-term thesis remains intact, that's not automatically a sell signal. Sometimes that's where patience matters most. Part 14. Theta isn't the only enemy. LEAPS. Investors talk constantly about theta decay. And yes, theta matters. But I think there are bigger risks. Buying the wrong company, overpaying, buying during extremely high IV, buying too close to expiration, using too much leverage, refusing to admit when the thesis has broken, and perhaps the biggest one, being right eventually, but running out of time. That's why expiration matters. I want enough time for the thesis to work. And as expiration gets closer, I become increasingly aware of how quickly the option's characteristics can change. I'm not trying to hold every LEAPS contract until expiration. Sometimes the right decision is taking the profit. Sometimes it's rolling farther out. Sometimes it's converting part of the position into shares. And sometimes it's exiting completely. The LEAPS contract is a tool. I don't become emotionally attached to the tool. Part 15. Protecting against the black swan. There is another reality we have to accept. We cannot predict everything. War, inflation shocks, credit events, political shocks, unexpected economic weakness, liquidity problems, anything can happen. So my defense isn't trying to forecast every possible crisis. It's position sizing, cash, diversification, avoiding excessive leverage, taking profits, and not allowing one thesis to dominate my portfolio. People sometimes think hedging means constantly buying puts. That's one method. But having 20% or 30% of your portfolio available instead of being 100% leveraged can itself be a powerful hedge. Because when markets panic, cash doesn't just protect you, it gives you optionality. Part 16. Know when to stop being aggressive. Perhaps the most underrated skill in investing is knowing when the environment has changed. There will be periods where I want to deploy aggressively. Strong earnings, improving breadth, healthy credit markets, reasonable valuations, sector leadership emerging, good technical structure, attractive IV. That's when opportunities deserve attention. But markets eventually mature. Valuations expand. Everyone becomes bullish. The sectors I liked 6 months ago become crowded. Risk premiums compress, and the reward for taking additional risk gets smaller. That's when the goal changes. I'm no longer asking, how much can I make? I'm asking, how much of this gain can I keep? That's when I start trimming, raising cash, reducing leverage, taking money out of LEAPS, and preparing for the next cycle. Because capital preservation is part of compounding, not the opposite of it. If you remember only one thing from this video, remember this. Sector rotation tells me where to invest. Fundamentals tell me what to own. Valuation tells me what I'm willing to pay. Technicals help me decide when to enter. Implied volatility helps me decide when the option is attractive. And LEAPS determine how I structure the exposure. That's the system. LEAPS are not the strategy. They're the vehicle. The strategy is finding strong businesses, inside strong long-term themes, entering them intelligently, giving the thesis enough time to work, and controlling risk when you're wrong. I'm not trying to predict the hottest stock next week. I'm trying to identify where capital could compound over the next 12, 18, or 24 months, and position myself before the opportunity becomes obvious. That's how I'm thinking about sector rotation with LEAPS in 2026. Not maximum leverage, not maximum activity, maximum conviction with controlled exposure. Because the goal isn't to win one trade. The goal is to stay in the game long enough for compounding to do the heavy lifting. Thank you for watching, and see you in the next video.